Welcome to the Empowered Investor Podcast. Have you ever felt overwhelmed by the sheer volume of choices and voices telling you how to plan or invest for your future? With his straightforward approach, host Keith Matthews of Toulette Matthews & Associates cuts through the noise to help you create a winning action plan for you and your family. The decision-making framework discussed in this show can transform you and your investment experiences and will increase your odds of becoming financially secure. Learn more and subscribe today at tma-invest.com.
Welcome to the Empowered Investor. My name is Keith Matthews, and I'm joined by our co-host, Lawrence Greenberg. Lawrence, how are you today?
I'm doing very well. It's great to be back on the show.
You're a co-host, and you've done many shows, but Marcelo's on pat leave right now, and you're going to jump in a couple of shows. I think you were on here a few months ago, so fantastic to have you back. How are you doing?
I'm doing very well. It's been a great summer so far. I actually went to Japan for the first time with my wife, Danielle. We had a wonderful experience, really the trip of a lifetime.
You're the second person that I know who went to Japan this year. Was it a great trip? How did you find it?
Yeah, I mean, it's become quite popular now, especially because the yen is quite weak and people are kind of flowing in as tourists. And my experience was, it's a wonderful place to travel, exciting culture, great cities, and very, very affordable.
Because in my mind, I'm thinking Japan's got to be an expensive place to be. I mean, it's always historically feels that way. Mm-hmm. Are you saying it wasn't as expensive as you thought?
Yeah, so I think that's a stigma from maybe 10, 15 years ago where the currency was very strong and now it felt quite weak. It actually felt like I was traveling on a discount compared to even Europe, which is quite surprising, I think.
How much was your flight from Montreal to Tokyo?
A flight, I got quite lucky. It was $1,300 round trip, and spending, shopping, travel within the country, very affordable, very efficient. So I think Japan isn't going anywhere in terms of a travel destination, really, for Canadians.
Wow, that's fantastic. $1,300. A lot of Europe is $1,300 from Montreal. And so sometimes you get $900 or $1,100, but $1,300 isn't unusual.
Yeah.
How about traveling inside of Japan?
Oh, it's so efficient. I mean, with their very elaborate systems in place of all their subways and trains and metros, the bullet train got us the equivalent of Montreal to Toronto in about 2 hours. And it would have been a fifth of the cost of flying from Montreal to Toronto. It would have been $60, $70.
Wow.
Which is unbelievable. Yeah.
Wow. So that is great value. And you were telling about us offline, your restaurants and meals and food was amazing quality at a fantastic price.
Totally. Yeah.
It goes to show you how much things can change over a decade. And it's a nice segue into today's episode because we're going to be talking about the decade that we're in, the mid-year review, but how things can change over time. So nice to have you back, and we're ready to go.
All right.
So in today's show, we're calling this the 2024 mid-year review. We're going to review portfolios and investments up until the end of July. We're going to discuss asset class returns, broad asset class returns. We're going to discuss styles. We're going to continue the conversation on technology, NVIDIA, the importance of global diversification. We're going to discuss interest rates, inflation, debt, and what that means to Canadians. And then finally, we're going to have a quick chat about U.S. elections. They're coming up in 4 or 5 months. And we're going to ask ourselves, how much should we care about this relative to investment returns?
Yeah, very, very topical. Yeah.
So, Lawrence, let's jump into asset class returns. So these numbers that you're going to share with us are asset class returns up until June 30th of this year.
Yeah. So this is for the first 6 months of the year. Very strong year overall. 30-year treasuries up 2.5, short-term bonds up 1.5, longer-term bonds in Canada about flat on the year. Canadian stocks up 6, U.S. stocks up 19, and international and emerging up 9.5, and global REITs flat on the year. So overall, a well-rounded year, 6 months for equities, and with U.S. equities really charging ahead.
Yeah, so 60-40 portfolios are doing well. Just as a benchmark, all equity portfolios are doing very well. Really, really pushed by U.S. equities again. This is a very powerful start. Question, what's driving it?
Yeah, so the big storyline again for the start of this year, similar to last year, was U.S. technology especially really driving the overall returns. Obviously 19% on the year for the S&P 500.
So what is the big stock name that everybody's talking about in equities?
That's definitely NVIDIA. So NVIDIA has had an historic run, making it one of the most, if not the most valuable companies in the world. It's pretty incredible to see. And those who have experienced the ride have seen the surge, but who knows what the future holds.
Yeah, and for our listeners, just to make sure everybody's on the same page, NVIDIA is a manufacturer of, I think it's microprocessors specific for the AI industry and specific for allowing AI to be implemented. So this is a company that's grown incredibly, and I think it's the largest company in the United States right now. $2.76 trillion
Of market cap.
of market cap.
That's a measure of how big it is, how valuable it is. To put that into context, that is roughly the same valuation of the Canadian stock market, which is incredible.
Yeah, that's unbelievable. One U.S. stock is the same valuation as the entire Canadian economy. We had a couple of other stocks. I think it was Microsoft and Apple, which were getting really close.
Mm-hmm.
And so now we actually have one that's surpassed. So if we strip away technology, how would the S&P 500 have done? It would have been lower returns, I'm assuming.
Oh, it would have been kind of in line with global performance, not nearly as eye-popping, right? So those handful of tech firms really drive the overall returns. We've seen that over the last couple of years, and so far this year, it's not any different.
So how do we respond to individuals who say things like, well, should my entire portfolio, because the U.S. market has just been going gangbusters now, really for 8-9 years, but in particular for the last 5 years, and then really supercharged for the last couple of years. How do we respond to individuals who say things like, well, why shouldn't my portfolio be entirely U.S. equities?
Yeah, it is a question we actually see from clients and just people talking. It's hard to ignore. But the important thing with investing is it's the process that you need to look at, not the results. You need to stay diversified. You don't know what the future holds. Even though the U.S. stocks have performed incredibly well, valuations still matter. For example, the prices of firms in the U.S. are relatively expensive.
Yeah, and then we'll get to that in a sec. But I'd also add that every decade is a different decade. And so you go through these decades where certain regions outperform. And we are clearly in the decade where the United States looks like it is the strongest return asset class. But it hasn't always been that way. So we go through periods, for example, from 00 to 2010, where the U.S. stock market was the worst performing asset class. And that's when Canadian stocks look amazing and emerging market look amazing. And so we do see these reversals. And it's very hard to identify in the decade prior, which will be
Absolutely
who's going to do the best. What you can use to, I think, help you are things like valuations and things like how expensive are stocks relative to others.
Yeah, so it's very important to have a sound process, not to chase things. It's very easy in the investing industry to chase the shiny new object, these new types of stocks or a region, but you expose yourself to higher risk. You don't want to start rotating portfolios, trying to make predictions. For example, over the last couple of years, all the large institutions that put up their expected future returns for certain asset classes, they've been saying to investors to expect lower returns in the US on a go-forward basis. That isn't how things shaped up, but the important thing is they're factoring in that, relatively speaking, compared to historical norms or other stock markets, the US stocks are relatively pricey. And we do not expect this type of run to continue over the long term. Prices do matter.
I remember in the year 2000, after a decade of incredible returns in the United States, if investors at large were surveyed and said, what do you think the return will be in the next decade? And the average return was something like 16%. And what did investors get? They got zero in that lost decade. And that's not to say that that's a prediction on our behalf. It's not. Even though certain regions are expensive, relatively speaking, we will still continue to hold them in their full allocations in the portfolio. And so that, I think, is absolutely critical to keep in mind. So Vanguard came out last year, I think it was a year and a half ago, where they talked about expected returns. And based on valuations, they put Canadian stocks, international and emerging market stocks as having the highest future returns. And they also put value companies and small company stocks having higher returns than large company stocks. And has that happened in the last year?
Yeah, so this year so far in 2024, it still is a large growth environment, but it's important to note that these things could be extremely lumpy. So types or styles of stocks come in and out of favor very, very quickly. Now, we've seen the month of June, July, especially July the past couple of weeks, small and value securities have rebounded in a significant way on the optimism or the hopes that rates will come down. And if you had exposure to, for example, a US small stocks, US small would have outperformed the S&P 500 by almost 11% in 1 month. Now, and you zoom out over the year, it's still closer to being at par or even large growth being a little bit ahead. But it's important to note that these things could come very suddenly and these swings happen very quickly.
Yeah, small company stocks have been out of favor for a while now, but their valuations are more attractive. And so you're absolutely right. And all this has come really, I think, in 14 days or 20 days. And in the investment world, they call that rotation.
Mm-hmm.
So there's been a rotation out of larger, more expensive securities into cheaper, more reasonably priced in the last 3 weeks. The question is, does it continue or not? We continue to do the same thing, which is recommend that investors hold the line and hold globally diversified portfolios that include Canada, the United States, international and emerging market stocks. And we think weightings that are reasonable are 30 to 40% in the United States, 30%, 33% in Canada, and that same weighting in international and emerging markets. And the last thing I'll say about AI is that the stocks that make the microprocessors and the chips get a lot of attention, as do the big 7 technology companies. But I think what also has to be considered is how AI can help all the different types of industries out there become more productive and save in costs and do things quicker and faster.
Absolutely.
And this is a growing theme that seems to be emerging now. So AI, you don't just invest in general stocks at large. AI will benefit and will add value to all the different industries out there in the different regions.
And as a global investor, you'll feel that bump as firms become more profitable and more productive. And that speaks to being invested in a process that is sound, that is well diversified globally, in the correct allocations for each person.
Correct.
Yeah.
We're very much optimists of the future with regards to expected equity returns, long term. So let's switch gears here a little bit, Lawrence, and let's go into inflation and interest rates. And I know that that has an impact on equities, but I guess let's start with inflation. How is it going and what does that mean for interest rates right now?
Yeah, so as it's been for the last year or two, rates and inflation have been at the forefront for investors. It's a top of mind. In Canada, we've seen 2 cuts this summer. So going from 5% policy interest rate to 4.5%, so 2 cuts. In the US, the Fed is anticipating cuts, and that's their language, and the market is expecting interest rate cuts. There have been none so far in 2024. And the European Central Bank has cut rates once by 25 basis points, 0.25%.
So we seem to have inflation not being totally tamed, but coming down, and that's something that helps all families. It also helps investors. I'm looking at this chart right now, Lawrence, which you put together. It's a fantastic visual. It's got Bank of Canada interest rate policy for the last 24 years. And if you go back to around the year 2000 to the year 2008, interest rates, Bank of Canada rates were hovering between 6% down to 3%, up to 4%. But I'm looking at this chart, and what it shows is from 2009, right after the Great Recession, when banks around the world had to drop rates dramatically to deal with the financial crisis, rates went all the way down to 25 basis points, 0.25 of 1%.
Wow. Yeah.
And they stayed from 0.25% all the way out until the year 2022. Sort of, we looked like we averaged about 1%.
Yeah, it's hovering in that zone.
And then there's this massive Everest of interest rate spikes going through. And when I look at this, what I can't help think is, wow, we've just lived through this decade of incredibly low interest rates.
Yeah.
And I'm going to take a few moments here, and I think that's impacted how people think about debt. And so I can't help believe that with super low interest rates, people had a tendency to think that money was cheap and perhaps borrowed a lot. And I think that's showing up in all the numbers right now. But with interest rates spiking, all of a sudden, all the borrowings that individuals undertook have become way more expensive to maintain and manage and keep up with.
Yeah, it's hard to adjust. And it's been this environment where especially Canadians have taken out large amounts of debts, whether it be for an expensive real estate market, for example, or personal spending, what have you. Canada ranks among G7 nations the very, very top of debt as a ratio of their disposable income. And Canadian households will feel that pain as now, for example, fixed rate mortgages are being renewed at now higher rates. There's less disposable income. Their debt overall is pricey, and it's taking a toll on the Canadian household.
Well, I mean, I can't help but think that individuals unfortunately picked up some bad habits, whether we want to call them saving habits, spending habits. But when interest rates are that low, the numbers you're showing here have Canada at 180%, just over 180%. We are more indebted than the United Kingdom, France, Japan, the United States, Germany, and Italy on a per capita basis.
By a significant margin as well.
That's right. Not by a little, but by a lot based
Yeah.
on these numbers. Just to put that in perspective, the average American has a debt ratio of 100% of disposable income. We're at 180%.
Almost double.
I guess the lowest is Italy at a whopping 90%. But I heard you can buy a home in Italy for $1.
Yeah. Yeah, you have to spend some to invest back into the home, but there's a lot of regions that are a lot more reasonable. Hey, you know what? Maybe I'll pick up and go to Italy.
Yeah, well, in today's world, you can telework, but not necessarily in our business. You know that we like to be in person with all of our clients and all of our relationships.
Absolutely.
But yeah, it's a striking chart. It really shows that Canadians have really strapped on the debt. Now the debt, the interest rates are higher. And the interest rate chart that we're looking at really shows that interest rates started to come in at sort of higher levels in 23 and 24. So interest rates are coming down, but nobody believes that they're going to go down to what they used to be in the low sort of 1s and 2s. Even if it stays at 3s and 4s, that means personal rates might be higher. Canadians are going to feel that. And they're going to feel if they have a line of credit and their line of credit is still at 4.5%, 5%, that's going to be a lot more expensive than when it's at 1 or 2 or 3%.
Absolutely. So it's important to have a firm grasp on your household finances, make good decisions. We work with our clients a lot on balancing these things, being aware of the risk, where should money go. The conversation of, for example, paying down debt or investing has changed drastically over the last couple of years. Debt used to be very cheap. It was a lot easier to say, hey, my free cash flow will go towards my investment portfolio. Now it's a trickier conversation with a variable rate mortgage being 7% or a fixed rate being 5 or 6 and all that.
So these are all totally relevant points in our mid-year review that we wanted to cover. The last one that we wanted to cover, Lawrence, was pending election in the United States.
Yes.
And again, this is not intended to be a long podcast episode, but a really good brief update in terms of what's going on. But we couldn't have done it without saying, okay, well, what about this U.S. election coming up? And should we be worried? Should we be doing anything in our portfolio? Should we make any asset allocation changes based on who we think may win or may not win? And again, this is not a political podcast, so we're not going into policies. But we're just going into kind of data and how things have looked in the past. So I'll open it up for any general comments on your side.
Every couple of years, this pops up, and the U.S. is such a force on the global stage, and people look to, should we do anything? If one candidate gets elected versus another, and how have markets behaved under the tenure of different presidents from both parties? And the consensus and the data shows that there is not a clear trend that a certain party or a certain president in office will dictate how stocks behave. We're seeing data going back almost 100 years and how markets have performed in the US. So the long-term average for the US stock market over the past 100 years has been 9.5% per year. And there's all these lines for the returns of different presidents in blue and red. And they all hover around that long-term average. And there isn't a causality that investors should look at.
Excellent points, Lawrence. I'm looking at, they've got blue lines for the Democrats and they got red lines for the Republicans. And one might think that, well, wouldn't it make sense that a more pro-business, maybe a Republican platform might be more attractive for equity returns? And the reality of it is it's very mixed. It's very noisy. It's also random. You can't really see because most of the presidents have had decent returns. Ironically, 3 presidents that we're looking at here, George W. Bush, Nixon, and Roosevelt, all had negative returns during their years. But everybody else is kind of like mixed and in the middle, plus or minus anywhere from 7% to 12%, depending on who the president is. There's no ability to interpret.
Yeah, and we have the data for it. And if there was a clear trend, investment professionals and the overall market would price that in as well, right?
Yeah. So what's your takeaway on this? What should investors do?
Well, this with everything is that you do not want to make predictions. It's not a part of a sound investment philosophy. You want to have a plan in place that's sound, and that's one that you could stick to long term.
I think those are excellent points, Lawrence. We're going to wrap up the show. The only thing I would add is mid-year, we've seen incredibly strong returns again, very robust portfolio returns, which is fantastic. The month of July continues to be very good. We would always recommend keep your portfolios globally diversified. Do not do market timing. Do not try to figure out what kind of major shift is going to come and then be smart and shift out and then back into something else. Typically, they don't produce the results that you want.
Well said.
So with that, folks, have a great week. We're gearing up for more podcasts in the month of August. We took a little bit of a break here. It's great to be back with Lawrence, and have yourself a great week, and we'll see you in a couple weeks.
Take care.
You've been listening to the Empowered Investor Podcast, hosted by Keith Matthews. Please visit tma-invest.com to subscribe to this podcast, learn more about how his firm helps Canadian investors, or to request a complimentary copy of The Empowered Investor. Investments and investing strategies should be evaluated based on your own objectives. Listeners of this podcast should use their best judgment and consult a financial expert prior to making any investment decisions based on the information found in this podcast.